Okay, hey traders, welcome back. This is the second part of the video about how to trade options. As I mentioned in the first video, I kind of have gotten to this point where I'm just trading and I'm talking about, different nuances to trading, and I've kind of left out, the fact that a lot of you are still new and are still learning, and I'm still learning in a lot of ways. But so let's go ahead and continue our video series. And I believe when we left off, we discussed the strike price, and we'll go from there. Before I go any further, please know that options trading products, services, and our information are for educational and informational purposes only. Basically, you are on your own. Please make sure you do your own research and don't risk money that you can't afford to lose. If you are going to risk money that you maybe can't afford to lose, please seek a professional registered advisor to give you their insight. Don't just base it on a video you found on YouTube, whether it be mine or someone else's. Just make sure you're doing all the right things to protect your money. If you remember in video one, one of the golden rules of trading options is protect your capital. So when we left off last, we spoke about the strike price, and that was here. So let's go ahead and when or what is the expiration date? So let's go ahead and take a look at the expiration date. And we talked about that a little bit just in the course of the last video. But the expiration date is listed here on Thinkorswim, and any platform that you use, there's going to be what's known as the option chain, and you'll be able to find somewhere at probably the top of that option chain here, it's August 16th of 2019. Now Thinkorswim also gives you this number here in parentheses. That's the days until, you can see it highlighted there on your screen, days until last trading day. So I have 16 days if I was to trade a call or a put in this option chain. But other platforms may not have the actual number of days. You may just have to look and know that August 16th is the last trading day. And that's when those options will either expire in the money or expire worthless out of the money, or expire in the money and be automatically assigned. So things we'll get into later. Well, there's the next thing on our list. In the money, for a call option, the strike price is below the market price. So let's go and take these one at a time. Okay, so in the money is below the market price. You can see here we're looking at GLD, or the Spider Gold Trust ETF, and it tracks basically the gold market. I believe it actually tracks, some gold held in some storage somewhere. I'm not sure. Regardless, it's irrelevant. It's a fairly liquid product, and it's certainly something you could consider trading. It's something I trade quite frequently. But you can see here the way this is listed. So it says for a call option, the strike price is for a call option, the strike price is below. So the key word there is below the market price. And if you look here, market price is 133. Well, all this shaded in purple or blue is all below 133. So for instance, 118, of course, is below 133. That makes it in the money. For a put option, the strike price is above the market price. So the market price, again, 133. Anything down here is considered in the money for put options. So it's just kind of reversed on the calls to puts. Out of the money for a call option, the strike price is above, and this is exactly the opposite. So if the in the money was lower, then out of the money will be higher. So 133, any of these strike prices that are highlighted in the black area here are out of the money. And conversely, for puts will be a lower price. So a lower strike price will be out of the money for puts. So just to recap, a higher strike price will be out of the money for calls. A lower strike price will be in the money for calls. A lower strike price for puts will be out of the money, and a higher strike price for puts will be in the money. So just make sure you're aware of that. At the money is kind of a really and truly, it can be just in the money or just out of the money. It's usually these two right here that I'm highlighting, or these four possibly. It's anything that's very, very near the actual market price. And so I can tell you here, for calls and puts, the market price is trading at or very near the strike price, maybe slightly in or out of the money. Okay, let's talk about exercise and assignment really quickly. Exercise refers to option buyers, those that have the right to buy or sell should they choose to exercise. For instance, let me come back to Thinkorswim. If I bought this option here, if I bought this call option and, you know, let's say some time went by and the market price was actually trading about 120, let's just call it 120. So if I was to go into the open market and buy shares of the GLD ETF, I would have to pay $120. Now, if I wanted to, I'm sorry, I got that backwards. Let's say at some point GLD was trading for 140. I apologize, I got this backwards. Let's say GLD was trading for 140. Well, since I bought this call option, I have the right to buy shares for $133. So I wouldn't want to pay 140 in the market when I could exercise. And I don't think I have any long call options open to show you, but basically what you would do in Thinkorswim is you would click here on your monitor tab, and you would just find where it says exercise, and you would be allowed at any point, but while the contract is still has time remaining, to exercise that option. So let's say some news came out and this thing was flying high, and you wanted to get in and exercise your option, you would have the right to do that. That's what part of buying an option contract entitles you to. It entitles you to the right to do something. In this case, with a call option, the right to buy shares. Now, if you were a put option, it would give you the right to sell shares. So if you didn't have any shares to sell, you could exercise your long put and sell shares short, but that would be another situation. So let's keep going. So assignment is the opposite of exercise. So let's say I sold, now let's pretend I sold this call option for 133. Well, if whoever bought, keep in mind what we talked about a while ago. So if I sold this, somebody had to buy it from me. Well, if that person decides to exercise their call option, now I'm required to be the person that sells this those 100 shares to them at 133. So again, if the market's trading at 140, I'm going to be required to sell this at 133. Hopefully I made sense of that, but it should make sense as we keep going. Exercise is basically refers to the option buyers, those that have the right to do something, right to either buy or sell. And assignment refers to option sellers, those that have the obligation. So remember what we talked about up here is a legally binding agreement between two parties. Well, this is the legally binding portion. You either have the right to do something or the obligation to do something. Okay, so that covers exercise and assignment. Let's briefly look at limit order, stop limit order, and stop order. Honestly, I don't ever use a stop order, but I'm sure you could. There are times when you may want to consider a market order, but those times are very, very minimal. So for now, let's just consider limit orders and stop limit orders. Let's take a look at those. So let's say I wanted to buy this call option again. So you can see here mine defaults to limit order. Now some people will have theirs defaulted to market. Basically what a market order is as soon as you click ask and it's highlighted at market and you click confirm and send, it's basically going to send this into the order queue, and it'll go to your broker, which I guess will forward it to whatever exchange that's going to fill the order, and it'll get filled at whatever the price is when it gets there. Now it all happens very fast. So if I clicked this button, of course not right now because we're outside of normal trading hours, but if it was during market hours and I clicked it with the market order type selected, it would basically get filled immediately. But what most people do, including myself, is they set a limit order. So if I don't think $3.30 is the most fair for this, well, I can come here and I can change this down and say, okay, well, the most I'm willing to pay is $3 for this particular contract. I'll of course have a limit order. I click confirm and send, and then my order may not get filled immediately. It may not get filled at all, but I'm guaranteed to get at least this price. There's no way I'm going to pay $3.30 because I've told them I'm not willing to pay that much. Now, a stop limit order is very similar. The only difference is you're going to set a trigger. So your limit would still be $3. Let's say I was already in this position and I was trying to, let's say I sold this strike price short for $3.20. Well, I want to make some money when I buy it back. So we'll leave our limit at $3, and let's say I want this thing to trigger at $2.80. basically what that's saying is when this particular strike call contract is trading at $2.80, it will trigger this order to exist, for lack of a better explanation. It will trigger this order into the queue, and then at any point between $2.80 and $3, remember you're trying to get the $3 limit order, it will try to execute it at this price or better. So it may be able to get you $3.05 if price moves to that level, but that's what the stop limit order is. A lot of times when I set this up, I don't do much different. I kind of just keep it right there, and that way it triggers right when it's ready to sell. But what happens to me sometimes is if you don't set this wide enough, it won't trigger in time for you to get out of there. If you've got a fast moving market and this thing flies by the $3 limit price and you didn't have this set to trigger at 280, it may move against you too far to actually get your order filled, and you kind of out of luck. So just make sure you know that if you're going to use stop limit orders. All right, moving right along. Market order we talked about. Delta, Gamma, Theta, and Vega, also known as the Greeks. These are important terms to know for option traders, but they're kind of an advanced concept. So we're just going to read them here, and then throughout the course of this video series, we may get into some more discussions about them. Honestly, I don't use them as much anymore as I used to. But they are good measurements to kind of identify where your overall portfolio is. And really and truly, Theta and Vega kind of take the lead here for me, but they are all important. So I'll just read them in order. Delta is a theoretical measurement highlighting the degree to which the options premium changes for every $1 change in the underlying. So basically what that says, and you can see I've got Delta pulled up here. So right now Delta's at 0.54 for this 133 call option contract. So if the gold ETF, GLD ETF moves higher by $1, this option contract theoretically will gain 54 cents. And you can see as you go further in the money, you're trading almost on a one-to-one basis with the GLD ETF, with the underlying instrument. So if I bought the 123, let's say, of course I'm going to pay a very high premium, but it's going to trade one-to-one with GLD, almost one-to-one. So for every dollar increase here, I'll gain 91 cents on this 123 strike call option. It's a theoretical measurement. You may end up only gaining 75, 85 cents. But it gives you a little bit of insight into how the option contract is priced and how it will move. Gamma is one that I don't really use all that much, but it is the theoretical measurement showing the rate of change in Delta for a $1 move. So as we talked about, as you go further in the money, this Delta price changes. It goes higher and higher until you get to a point where it's as high as it really can be. And really and truly, it can be all the way at 1. Let's see if I can find. So we have to go to one of these longer term ones. So you can see here Delta is at 1 on these longer terms. So if you were to buy into one of these contracts, it's going to move one-to-one. For every dollar move here, it's going to move a dollar there. But if you were to buy, let's say, this 139 call option with a 50 Delta, well, you can see every dollar that it moves higher, you're gaining 2, and then again 2 more, 2 more, 2 more, 2 more. So the gamma is basically telling you how much for every dollar move the Delta will go up. So in this case, you can see, without having to have gamma pulled up here, you can see that gamma is moving up by 2 cents with each contract. And as you go further in the money, you can see now it's moving up by 3 cents and then only by 1 cent. Gamma just tells you the rate of change in Delta. So it's, again, not one that I use all that much, but the two that I use the most as far as trying to determine what positions I think are favorable, and that's Theta and Vega. Theta is the theoretical measurement of the effect of time decay. So if I sold, let's say I sold this option, let's analyze this trade, go to risk profile. So there's my position right there, day 1. I got my dates right. 116, yes. So there's the position. If I was to sell this today, there's my position right there. You can see I would probably want to get this at a little better price point, probably right there, if I was going to enter this trade today. And that way I'm not starting off kind of negative. You see where it's already at profit or loss is $1. So basically, as soon as I get into this trade, according to this theoretical risk graph, I'd already be down by $1. So I'd want to try to just bump that up just to get it, you know, even money. But if I could put it right on that red tick, it would be 0. Regardless, theta, you know, for at this point in time is at $1.09. So for every day that passes, that this, no matter what the price does, for every day that passes, I'm earning $1.09. So you can see as time goes by, theta will increase. You can see it's increasing fairly slowly for this contract. But let me go back to today and let me show you how this works with, see, that's what they call a leap contract. That's a way out in time. But let me show you how theta works on one of these shorter contracts. So let's say I sold this. Let's analyze that. So I need to get this set to the right day. So if you're ever using the Analyze tab, just make sure this is set to the right day. September, August, because sometimes when you're looking at multiple different options contracts, it'll stay on the last date, which you can see is 2021. So it won't give you the right numbers here. So just make sure this is at August the 9th. And really and truly, I go to 1 day out. So now we're at the right point. And you can see if I put this right on the red tick mark, it's about 0. So that's actually a little bit more favorable, but then again, it's not right on there. So somewhere in there, about right at 0. And you can see now theta is at $6.68. And as this moves forward in time, closer to expiration, you can see theta increasing substantially. So if the underlying price didn't move and this call option just continually decayed, you would earn this much in premium each day that passed. So that was a little more long-winded than I wanted it to be, but that's theta. And then vega is the theoretical measurement of the effect of a 1% move in volatility. So volatility, let's pull that same contract back up. So vega, you can see, is minus 4.81. So basically what this is telling you is you want a negative move in vega. You want vega so you can look at the VIX. So right now, if I was in this position, I wouldn't have been all that happy because the VIX moved higher. But if you sell an option with a high volatility, you want volatility to decrease, because every time volatility does, you'll earn this much for every 1% move. So if volatility, I don't know what 1% of 16 is, I guess 1.6. So this is almost a 1% move. So if I was in this trade, theoretically, and it went up by this, by $2.18 like it did today, of course, the VIX is just a measurement of all the different stocks in the S&P 500. It's basically the put option buying, but it's a metric to use to gauge where volatility is in the overall market. But it really comes down to where volatility is in this particular ETF, and you can see those volatility numbers here. So if this were to go up to 1921 or so, I would theoretically lose $4.81 if it went up by 1%. Now, if it goes up by more, you're going to lose more. If it goes down by more, you're going to make more. So that's just a quick, in a nutshell, explanation. But I think we'll stop there for this video, and when we come back. Okay, so we won't stop there. Actually, I had to pause the video. I didn't realize I had this image here, but click on it, make it a little bit bigger, and just kind of go through here. So you can see this is the call option chain, which we've talked about. This side is the put option chain. You can see the April 2016 call option strike price. This image is a bit older, but all the stuff we've talked about is the same. You can see I've got notated here, anything in the purple is in the money. Right here, where the strike price is very near the market price, is at the money, and then out here is out of the money. Same thing on the put side, out of the money, at the money, in the money. And then you can kind of see the bid and ask spread here of 2 cents in this particular image, which is a fairly liquid market. Kind of a little secret to trading is if you have a really tight, 2 cents, 1 cent, even up to 5 or 6 cents as a bid ask spread, that's pretty liquid and you can feel pretty comfortable trading it, that means the market makers are maintaining a market there. It's not until you get to a bid-ask spread of $1 or $2 or $5 that you should really kind of steer away from it, unless you're trading something like Amazon or Google, in which case their markets would be a little wider, but there's still plenty of liquidity there. So just make sure, if you're not sure about the liquidity, just make sure you look at this open interest and this volume number to make sure there are actually contracts being traded prior to you placing a trade there, because nothing worse than selling something or buying something and then seeing a profit, an unrealized profit that is, and not being able to close it and actually realize that gain. So next we'll get into the option basics, and we'll kind of start to hash out the details of each one of the things we've talked about, and and then before this video is done, we'll look at a simulated trade and kind of teach you how to do that. So I apologize it was so long, but if you have any questions, feel free to reach me at optionboxer.com. Thanks for watching.